Hello everyone, hope you're all well and have been enjoying what feels like a slow return to something approaching normal life. But was hopefully some improved weather as we enter the summer months here in Europe. I'm Jeff Ando, Content and Production Director at GTR, and I'm delighted to welcome you all to this latest GTR webinar, which today looks at the future of commodities, a big topic for a big sector. Like many other industries, the commodities and commodity finance sector have faced a series of unprecedented challenges over the last few months. We'll be seeking to address these challenges over the next 75 minutes, along with other long-standing themes such as technology and sustainability. We've got a special Q&A session at the end, and we'll look to go through any questions then, bringing speakers back in where relevant. I'm now pleased to introduce our first speaker for today, Christine McWilliams, Global Head of Commodity and Energy Trade Finance at Citi. Christine joined Citi in 2011 to establish the commodity trade finance business after holding a variety of roles in commodities and energy. She's currently based in Houston, so has got up very early to join us, for which we're hugely grateful. Welcome, Christine.
I sure am. How is everyone? Listen, thanks for having me. It's a real pleasure to be here with everyone. So with what's going on in the last few months, most of us are concerned about the speed and the strength of demand recovery. And it's worth noting that Latin America is still in the midst of their COVID-19 battle. So both confidence issues around the return to normal, whatever that may look like, and then perhaps longer term changes to work practices are going to have a ripple effect through our commodities. And if that wasn't enough, you can layer in potential for additional China-US trade scuffles potentially, and then certainly in my country, US elections in the fall. It certainly is shaping up, as you say, to be quite a year for commodities. So I'd suggest a couple of actions make sense right now. And the first is that a strong balance sheet is really critical, more now than ever. So we're facing potentially prolonged periods of market stress. We don't know when and how this recovery will really take shape. And so a management team that has experience and takes calculated action when needed, has really solid counterparty and risk policies, and also really focuses on having a very diverse set of access to working capital sources and tools is going to make a real difference. So matching short and long-term projects to the right kind of financing, and even possibly paying up for financing to allow the freedom for opportunities that you haven't identified is going to be very critical this year. I also think there's a real focus on counterparties this year and your supply chain. So high standards in the credit process are particularly important right now. Some counterparties will suffer credit events. Others may ask for extended payment terms. They may request delayed delivery schedules because they have excess inventory. So counterparty credit assessments and determining appropriate credit support, really important this year, and more so as we go through the year. And so maybe companies consider selling more AR than usual to free up risk limits or to allow for those longer payment terms. And it really is the year of the counterparty. It's the year of the supply chain this year more than ever.
Great. Yeah, I mean, with regards to, I guess, that practitioners building their resilience, what tools do you think traders can explore and leverage to prepare for business recovery and successfully adapt to that change in the landscape?
Yeah, it's a good question. What do we do now? I would do two things. First is digital solutions. So certainly with COVID-19 challenges, it was initially about continuity of business. What do I do because I can't get a wet ink signature anymore? How do I address that? But now the challenges are more around managing long-term changes in your supply chain and how you approach work. How do I prevent fraud? How do I track my inventory now? How's my work changed? And so in this sense, I think digital tools will see an even greater adoption rate and more extended implementation than what we have ever seen before. And so that does force us to look at some of the barriers to entry that we were seeing before. And one of those is IT budgets. Another is legal and local jurisdictional requirements. But I think one of the real barriers really is how we see our work. And so it's the human aspect of how I get work done every day, and how do I use that digital tool as really part of my new processes, and how do my compliance officers see those digital tools as part of their normal processes. So as we look at integrating digital tools, I think it's going to be really important to really take a look at how flexible those tools are. as we transition, as all of us transition at different paces. Can we do some of the transaction on the platform and some not? How scalable is that tool? The tool needs to be useful worldwide. And so all of that's going to be key, particularly for our industry. But I do think digital tools are here to stay more strongly than ever. And I'll just note that it's nice that they also tie in with ESG efforts. So any company's effort to reduce their footprint or reduce any kind of emissions, digital tools and what that enables really fits kind of nicely into those agendas as well. So that's the first thing. The second is maybe a little bit old-fashioned, but it's the tool of communication. So there are a lot of traders who routinely have very open conversations with their banks, and that kind of open dialogue and high quality information exchange gives a lot of confidence. During times of market stress, banks tend to have a more strenuous due diligence process, and we ask relentless questions. And those questions really can help inform a company on what traders are worried, or what banks are worried about. And so it can help the trader then to think through more around the kind of information to provide. And that creates a really nice circle of dialogue that gives a lot of confidence to the process. And I'll just mention that I had a conversation with a risk officer at a bank recently, and he remembered several years back that he talked with a client who was fairly new, and there was a hiccup in a trade strategy that just didn't go according to plan, which we all know can happen. And there was a fairly large quarterly loss, and so he asked for some details around how it happened, and he said that the quality of the data and the quality of the conversation around this trading strategy gave him the confidence to stay the course. And so as much as we might move to digital solutions and use more technology, I still think that the human element and old-fashioned dialogue is going to be just as critical. So those are two things I think through.
I guess as a follow-on question from that, and probably very relevant representing a large financial institution, is there enough liquidity to go around, and how have those sources of liquidity changed?
Yeah, that's an important one for us now, isn't it? So I'll just say that I think despite the challenges that we've seen with some defaults and accusations of misdeeds that have come forward to late, I think it's unlikely banks will abandon proven structures such as transactionally secured financing, on the basis of recent events alone. Transaction financing and then the structured financing that supports the longer tenors are going to continue to be staples. With extended grounding of travel, due diligence will have some challenges. On-site inspections and some of the other things we do in our structures will look a little bit different. So it's possible we might see higher compliance and monitoring costs. It's possible that we might see changes in the kinds of warehouses or inventory sites that are acceptable. We'll see. But all of those certainly do mean that there is the potential that smaller loans are less attractive just because they will cost more because of these overlays of requirements in the near term. As we move through the year, though, I think too that because of the kind of expertise and knowledge that it takes within an institution to really have a nice interface with a commodity client and really support them well, it's not just the banker, but it's also the risk officer, the legal folks, the operations staff, all have to work together. It is possible that we might see some institutions making the decision to focus on certain geographies where they're most comfortable, certain types of structures or certain commodity types where they really have the most confidence, and so it's possible we might see that as well. We'll see as we go through the year. So
great. Well, thank you, Christine. Thanks, Christine, for that introductory overview of the market. We'll be having some questions later on, so we'll bring you back for some of those potentially. Our next section looks at how technology is evolving to meet changing industry needs, whether for traders or for their banks and other financial providers. And to guide us through this, I'm delighted to introduce Michiel Menertz, Partner, Treasury and Commodity Management at PwC. Michiel is a director in the advisory practice at PwC, where he leads the Geneva-based commodity trading consulting practice. Michiel, the floor is yours if you could also introduce your fellow speakers.
Yeah, thanks a lot, Jeff. Indeed, so I'm a partner at PwC Switzerland in charge of our commodity management consulting practice here. And well, thanks a lot for giving me the opportunity to contribute to today's discussion. So with me today are Solima Badi, so the CEO of Comgo, and Frank Gouverne, so the CEO and co-founder of Rice Exchange. So maybe just a few introductory words before we get into the discussion. So, I mean, the commodity market has always been, a turbulent area to work in, with more than enough topics to keep us busy. But I think today, in the current COVID-19 circumstances, we're definitely at another level. And I think that's also a bit of context for the discussion we will be having. I mean, what we want to cover in this part of the panel is to talk about how technology is evolving to meet the industry needs and deal with the cost pressures that we generally have, and also the need to go digital in an industry that is still, as we all know, very archaic. And I think also to echo some of the things that Christine said before from Citi, there is this need for greater transparency in the supply chain, also to help on the financing side. And of course, COVID-19 is influencing all of this. Some of the things that we're seeing from the PwC side on this is there's an increased focus on the importance of for example, food security and supply chains generally. We're seeing an increased adoption of digitalization in that respect, and also on the bank side, we've made some very big steps forward due to COVID-19. I think there's years of innovation and progress in just a matter of months, so I think that's a positive side effect. We see an increased call for transparency and also governance coming from the banking sector, and I think some of the negative stories that have happened in the commodity sector over the past months, as part of the crisis, are putting more pressure on that, and we actually also seeing some requests from clients coming our way that they want to revisit their governance model, they want to revisit their policies, and also their technology setup to actually have those conversations again that Christine was referring to earlier, showing that the risk management in their company is at the level required, and this is actually requests that are in some cases directly driven by the bank, by banking partners and stakeholders asking for more in that area from our clients. Last thing to say, I guess, is that an observation is that obviously virtual collaboration has made a big leap. I think this webinar is an example of that, and we've seen in our experience that it is really possible and to make progress on technology also in a virtual manner, and that was an interesting lesson we've learned, that technology projects can run virtually and progress can be made also in this model. And that's something that's going to be interesting to how we actually approach further development on the technology side in the future. But anyway, just a few words of introduction to put context. Maybe I'd like to kind of hand over to maybe Solima first, and then Frank to do their personal introduction, and also be great if you could tell us a little bit about your company and and your role in the way forward on technology in the trading sector. Solima, would you want to go first?
Sure. Hi everyone. Thank you, Michiel. Thank you, Jeff, for inviting me. Yes. So by experience, I'm a banker. 18 years at SocGen, and 10 years ago, I moved to Geneva to launch the trade and commodity finance business. My background was really different, and one of the things that really surprised me, if I can say it like that, was the way this industry was operating, right? I think you all see what I'm talking about. Very much paper-based, very much wetting signature, very much old ways of operating, totally disconnected with the world we are in today as private individuals, if you look at your phones and your apps. we have been working on this as a team in the bank to try to understand how we could make this happen and change, right? How we could change these ways of working. And Congo is, we came to a conclusion where we knew and our vision was that we could not make this happen in the bank, because if you want to set up different ways of working, you need to do it with the industry. So that's why we left SocGen, and we were even pushed to do it by the bank, to create this company with the industry. It's an industry-owned company. It's a company where the industry is teaming up to build its solutions, its new ways of working together. So it's really the production phase of our digital journey, and that's our history and why we're here today.
Thank you, Sulema. Frank, from your side?
Yes, good morning, everybody. Thanks for having me and giving me the opportunity to talk a little bit about Rice Exchange and exchange also ideas with you on digital platforms and what's needed today. So as a small introduction, I started in the rice business since 1986 as an international rice broker, managing director of Skepers & Co. in Belgium. And then in 2000, I moved to Geneva to be co-founder of Novel Commodities, which used to be one of the bigger rice traders in the world. I left them in 2011 in mutual agreement, and then moved on to some other missions and also be independent consultant in rice. Until 2018, I met with Stephen Atkins, who is now the CEO of Rice Exchange. We were in a project together of growing rice in Nigeria. And Stephen, who is not a rice guy, he discovered how cumbersome the rice trade is and said, we have room to improve this, and we have room to change that way of doing, which I have known for so many years to be old-fashioned and paper-based and with a lot of insufficiencies, which we all accepted for a long time. But now we can see that the world is changing and that the world needs something else. So that's why we decided to launch the Rice Exchange. It's quite exciting because we actually just before the launch in a few weeks. So that will be a nice moment. And we are building effectively a digital marketplace. So it's going to be an ecosystem where the buyer and the seller can trade in trust. We have consensus by workflow. So we are also working with integration partners. We have, for instance, inspection companies on board. We have shipping lines. We're working with one of the biggest shipping lines in the world in container Maersk. We have a partial shipment solution with Ducat Maritime. We have also a dedicated insurance solution for our users. So it's all one package. It's a one-stop shop, which has the idea to bring visibility, transparency, and create an environment where people can trade in trust. And also, of course, where they can give trust to their respective bankers, because there is a lot of things of fraud and a lot of fake documents circulating and people really getting cheated from time to time. So we want to make a solution for that and work in an ecosystem where people can be working in a trustful way. That's in a nutshell a little bit what we are about.
Great, Frank. Thanks a lot for that. And that definitely sounds, very promising and very interesting. And I think it begs a little bit the question, why has it been so difficult for this industry in a broader sense to actually make progress in digitizing its processes?
I think that we all know that this is a tailor-made industry with no standards or very little standards. Many stakeholders spread all over the places, many different regulations, and very different vision on what digitization should be and how we make it happen. So if you look at the stakeholders who take decisions and fund this digitization process, they are completely convinced by the concept. They truly believe in it. They love new technologies. They operate through labs most of the time. But what they don't capture is that when it comes to people who are really going to use it on an everyday basis, who have to master their work with new ways of doing everything, change their processes, and this has to be done on the long run, they have other expectations and they want a tool that brings them efficiencies, that brings them security, that brings them immediately, without being patient, very simple ways of making things happen in a better way. So that's kind of the challenge of building this tool and being able to fund it and build it, and being able to have real users on the other side who are really convinced that it brings added value to them. So I think that's maybe one of the main reasons why it has been so difficult, and it's still a huge challenge, by the way, to execute.
No, I just wanted to say I fully agree with Selema on that. I think that one of the things we need to remember that it's not about going digital, it's about bringing solutions to real life problems. And I think that's what we need to focus on as an industry. And that's really what we try to achieve in Rice Exchange. We try to bring, like other platforms, we try to reduce the risk, the risk for all the participants in the flow, including the banks or the financing institutions, including the buyer and the seller. If we talk to our potential users or future users who have signed up to the Rice Exchange, all of them are saying, equally the buyer and the seller, how can I reduce my risk? And I think we really have a way to do that by bringing a consensus, but also by technology that is based on the DLT or the blockchain, where we can really see what has happened from A to Z. It's immutable, you have audit logs, and all these things will help adoption, because if we solve problems, then really we will attract attention of people, and that's what it's about, I think.
And how have you seen COVID-19 affecting the situation? I mean, if I look at some of the stories that I heard about, DHL no longer working in certain territories, or people still having to go into the office to sign packs of physical documents. Is the current situation, has it created a push for your respective platforms?
For sure, we have two impacts here. We have the COVID-19 impact, which resulted in a very clear statement about moving digital. There's no more debate around it, right? So CFOs are convinced, operational people are convinced, they have no choice than to move. The question is more, how do we make this change happen? How do we make it sustainable? How long does it take? And how do we make it without disrupting too much their teams that are already swamped with many other risks and problems to manage? So that's the first impact. I think the second impact we have noticed during the past months is the increase of fraud in the industry. Obviously, it comes with the COVID too. And we are in a situation today where there's a huge topic around trust, even more than before. And there's also a huge topic about surviving in this industry. And if you look at both customers and banks, it may be the first time where both of them are totally aligned on the fact that they have no choice than to change to be able to continue doing this business. So it's even for some institutions and key institutions in this industry, moving digital today is also a way to survive. I mean, as a client, you want to show to your bank that you have adopted the best practice, that you're not consuming too much of their resources, right? That you are able to show what you do with your documents, which is even more important now than before. If this invoice has already been financed or not financed, for example, you want to be able to prove that to your bank. And I think customers have a very clear understanding that they have to make this happen in order to allow their access to liquidity, right? So it is a game changer, no doubt, for the industry.
Yeah, on top of the motivation that a lot of people have, because look, if you look at container lines, there are studies that blockchain or digital environments can save them 20% of the freight, which is now spent only on paperwork. So it's huge. If you look at the number of containers moving around in the rice trade, for instance, we have 48 million tons of rice, which is traded semi-private basis. 70% of that goes in containers. So if now you are saving maybe not 20%, but you can save 10% on the freight just by optimizing the process, it's a huge saving. A lot of people are moving into that direction, and it's not just for the fun of it, but I think that it's also a must, and to cut the risk also for shipping lines, because they know exactly where are the documents, they know exactly who is the rightful owner, they don't have legal issues of releasing the goods to the wrong people. Things like that is also very important. And if we see the initiatives of all the container lines, for instance, they are grouped in an association, Digital Container Shipping Association, and they are now saying, we want to move forward and make a common policy for e-bill of lading solutions, which is very encouraging. And I think we need more of these initiatives to really push this forward, and also go to the regulator and tell them, okay, we need solutions, we need new laws, we need to come up with new regulations and accept this kind of documents, which so far has been a problem for the banks, because those regulations are not always updated, and banks have to work in a certain legal framework, and sometimes they just simply cannot change the method of working because of legal aspects. So Lema, you have to correct me if I'm wrong, but I think this is what we also see a lot.
Correct.
Mm.
So I think that's I mean, that's interesting, right? There's a lot of drivers in a way to go forward in terms of, you know, I think, as you said, cost efficiency, trust, and so forth. And you know, how do you see your respective platforms, you know, contribute to making progress in this area?
What we are trying to do is really to bring added value to the users. We are very much user driven, and most of them are afraid of this change of ways of working. So we're trying to make things as simple as possible, and bring them tools where they see immediate added value in terms of efficiency. So managing their workflows, their approval processes, their documents, and in terms of additional security and rebuilding the trust. So it's really making it as efficient and simple as possible to allow people to start somewhere, to see the benefits, and to build on that. Changing ancient old ways of working is a big challenge. So really make it simple, efficient, and useful for the users. That's the key driver. And this is also why this company is backed by both sides of the industry, in financial institutions and clients, because we're trying to build a solution that matches both sides too, to be able to bring more added value to the final users.
Mm. Yeah, I would say yes, that's the key, I think. Make it easy, bring added value, bring what people need, and at the same time try to solve big issues they have. Surely the world is not ready, that's clear, but I think we are moving into a direction. We see a lot of initiatives going on. We see a lot of people talking about it, and I think that the COVID-19, unfortunately, what happened in the world has opened the eyes for people to say, well, we need to change something, because some people have been just accepting to pay, for instance, letter of credit against fax copy of documents. So what's the use of opening an LC if you accept fax copy documents? Some people got vessel stock because they could not discharge. So it's real problems they have, and also I think the players in the ecosystem shall start to understand a little bit more that need is change, or change is needed, let's say this way.
So I think Frank and Sulema, maybe a last question before we probably move on to the next session. You know, I'm sure you're very close to also some of the other initiatives, you know, that are happening in the market, and of course a big one that's out there is the ABCD initiative, or I should probably call it now the ABCCDG initiative, with the, you know, the big agricultural players coming together. But there are also others. You know, what's your view on what you're seeing in the market, and how, you know, and how important are those other initiatives?
Yeah, I think it's very encouraging, let's put it that way. I think the more people start to work in this industry with this kind of solutions, the quicker we will have most likely adoption, and also support maybe from the regulator more, and eventually opening also discussion with other partners in the ecosystem. It can only be helpful. We see that indeed there are a lot of initiatives, okay, and everybody works in a different way. There is not a uniform standard neither. If you look at okay, Comgo is building on a certain technology. We are building with Fujitsu on Hyperledger, for instance. Others are working on another one. So also the interconnectability of all these platforms, it's really something which is important. And Christine was mentioning it needs to be a global solution. Ultimately, yes, and we need most likely open systems where we can link into. We need not to reinvent the wheel ourselves for everything, but ideally we should be able to connect to others and find solutions together. I think this is quite important. Unfortunately, today we don't have such a communication going on with other initiatives, or well, not on a very formal basis, I would say. Maybe what we need is also an association to start talking about this kind of real life problems, and see how we can advance all together, putting the knowledge on the table. I think this is quite important. Teamwork is what, or exchange or something like this is what we need to push forward also the industry.
Sulema?
Yeah, just to add on what Frank says, it's given the complexity and the size of this industry, it makes sense to have various ways of digitizing it. Again, the question at the end of the day is how do we bring added value to the end users? So it will be our responsibility to establish the right connections and to make those platforms work together when it makes sense for the end users. And for that, we need to cooperate on a regular basis to make it happen, because it will only happen with many parties involved, right? No, I don't think you can have one solution that takes it all. So we have to, it's our responsibility to make it work with the others to bring added value to the end users at the end of the day.
And that's quite interesting, because if you look at Rice Exchange and Comgo, we are not competing platforms. We are in the first place a marketplace and an ecosystem for specifically the rice. So it's something which is complementary, and I believe that there are a lot of things we can see with other platforms also, how to move together and how to eventually have a certain push from the industry, because we represent a big industry altogether, and maybe we are having a voice also to make things happen and change.
Thanks to both of you for that. I think maybe before we move to the next session, just a very brief kind of closing message you would maybe like to give to the audience. So Sulema?
Yes, I think there's no doubt that things are changing. I think that some companies have got it very well and are early movers in that respect. I think my message for you is, yeah, you have to start somewhere. Make it simple, choose a place where you want to start testing it and using it, and see how you can take it from there.
Yeah, I think I just said my last lines, saying let's move and let's work together and push this industry and see how we can really make things change. That's really how to adapt to the new technology. That's really what we need, and I hope it will move forward like the dynamics we are feeling today. Let's keep it going.
Great. Thanks a lot, Frank. Thanks a lot, Suleima.
Thank you.
That's wonderful. I'll hand over back to Jeff.
Thanks to Mikhail, Suleima and Frank. Our next conversation is a hugely topical issue, with many trade finance banks having been impacted by the recent collapse of several notable commodity traders. This segment will seek to address some of the deeper issues exposed by those developments, asking to what extent changes are needed in how risk is assessed. To do this, we first have Natalia Frolova, who's an independent finance and insurance expert with over 20 years experience in international trade and trade finance. Natalia, perhaps you could give some initial thoughts on these recent developments.
Thank you, Jeff. I'm delighted to join GTR and my fellow speakers for this fantastic event. And so my today core speaker is Alexander Peters, Director of Finance and Administration in Aero Metals. And I would like to kick off with saying that I'm particularly interested in the risks topic for two reasons. The first one, I'm an ex-banker, and in my last role, I was working for a corporate and energy trading group. It means I did credit checks and due diligence on the banking side, but I was a subject to such checks when I was with a corporate company. The second reason is that I'm now doing a certificate in combating trade-based financial crimes. And in my humble opinion, frauds are happening a bit too often lately, despite regulations being even tighter. To make the game fair, I would like to mention that the fraudsters are getting really smarter, and the banks are not the only part of the business community that suffers. Read about the recent case with Lecoil. Shares are traded on London Stock Exchange. In this case, the company thought that it was about to borrow from a very esteemed institution and paid a substantial consultancy fee to arrange the deal. The result is no fee and no funds. When I try to reflect on everything what I read about the recent cases, and these are not only Agritrade, Hinleon, Zenrock in Singapore that are probably the most famous right now, I cannot escape the feeling that I'm really struggling to understand how did it happen. International trade is indeed a very complex environment with multiple intermediaries, and it's far from ideal in terms of technology and documentation flow. And so, by the way, it's fantastic comment in Q&A from one of the participants about the efficiency, and if this is indeed something that the participants of the market are after. Take, for example, LOIs that trading companies use to discharge goods without an original bill of lading. And how come that in the 21st century, before COVID, when anything can be delivered anywhere within 24 hours, we do not have an original bill of lading at the discharge port? And don't get me wrong, I do know the answer, but I'm still really amazed. When I started my banking career, I was doing a bit of a credit administration job. And so the bank I worked for funded a car dealer with floating charge over the cars in the stock, still selling and buying cars. And my job was to go to their warehouse on a weekly basis and to compare VIN numbers of the cars pledged and recorded in the surveyor report with the report that was provided by the dealer itself, with the real stock that I would see with my own eyes. And I had to come up with my own version of the inventory list. And if there were any discrepancies, the bank will have a very detailed conversation with the dealer and probably will reconsider the next tranche under the credit facility. And the dealer knew that the bank guys were coming on a weekly basis. And if there were any hiccups, they were reported to us even before my arrival to the warehouse to try to find a solution how to top up the pledged value. And in my opinion, that all existing models in the world of the credit analysis cannot replace regular visits to the warehouses and inventory checks that are done by the bank itself. Lending is not a desk job. And hence I was really stunned when I saw in one of the articles about Hinleon that the inventory stated on the accounts for 2019 signed off by Deloitte was 1.27 billion US dollars. But when it was evaluated, it was $141 million US. You know, the difference is really mind-blowing. And it was particularly interesting in the light of another article that I saw 1 year ago. It was about one of the Hinleon lenders who engaged a very interesting technology and drones that were flying over tank farms to measure the inventory pledged to them. And I would be very curious to see what kind of data they were getting from such inspections, if any. I can also recall being on the corporate side, quite exhaustive due diligence that and checks that I faced when I was working with my previous company, where these particular companies that now in the press were subject to similar scrutiny. And have we as business community learned anything from the previous cases like Qingdao fraud 2007, 2008, or are we trapped in this ever speeding up trading cycle, and even current technologies like blockchain will not be able to cope, as it seems every other technological upgrade becomes even more costly and there are too many middlemen. So from one hand, I'm preparing for my compliance certificate. I'm reading about regulations becoming tighter and tighter, especially in the trade finance space. From the other hand, there are some really stunning facts, like for example, Hinleon being a family firm was subject only to a very light form of audit. And on this really tricky note, I'm going to pass the floor to Alexander, if I may.
Yes, thank you very much for inviting me to this panel. You know, as already mentioned, my name is Alexander Peters. I'm Group Finance Director of Aerometals Group, including AOT Energy, and I'm sitting on the board of the Swiss Commodity Club. So, what I want to stress, you know, there were so many questions, you know, recently, whether, you know, the amount of trade finance extended, you know, to large trader is too much. Should it be restricted? One point that we definitely need to reiterate, that trade finance lending is definitely, always was and will be one of the most secured lendings in the banking sector. On the other side, obviously, like for every credit manager, the central question is, when I do my credit assessment, you know, either from a banking side or from a trading house side, you know, what's the quality and accuracy of data that I'm getting? And obviously, as IT people like to call it, what is the single source of truth? So if I have inventory that I have pledged, you know, to a bank, you know, way of a trade finance facility, it's normally considered a very secure lending, because especially if you have a exchange deliverable product, which is fully hedged, and a holding certificate issued to the order of the bank. So how is it then possible that even, you know, if we roll back now in history and look what was happening in Qingdao, so it's not much different what we are reading in the press these days, you know, that a trader should have, according to his books, like inventory of 3.5 billion, but then at the end of the day, the inventory is not there. So that's obviously backs for the question, what kind of internal controls are in place there? Because as I always used to say, it takes two for tango. So if you have an inventory certificate stating that the goods are deposited to the order of the bank, and then next day, you know, these goods are gone, it's a question, how is it possible that so many layers of control have failed to detect something? And again, if we speak about the delta of a couple of millions, that may happen. It could be human error, oversight, unintentional behavior, but then in a large scale, as we have recently seen, it was obviously a concerted effort in order, you know, to defraud banks and, you know, the trading community. So the question is, how can we build a central repository? And we already heard, you know, in this panel, you know, some of the initiatives, you know, maybe a new huge wave of digitization, like we had it, you know, electronic depository, a repository where you would have a central database which could be reviewed by banks and traders. So if somebody states that has 1 million barrel of oil, in a tank farm that everybody can look up and make sure that the product is there in this quality, it's stated in the certificate, and obviously, to the order of the financing bank. So again, now in the aftermath of COVID, in a pre-COVID and post-COVID environment, we see the trend, that there is a huge disruption in the supply chains, and obviously the entire commodity universe is being reshaped as we speak. New players entering the market, some of them will disappear. We will also see a huge wave of consolidation in the market. So the question is how to structure credit management going forward in order to be able, to tackle fraud and to tackle delinquent buyers, suppliers, whatever the case may be. So as we tend to say in German, and this is just a loose translation of it, trust is good, control is better. I'm absolutely in favor of an industry-wide standard of being able, to detect inventory positions and also to report it to the financing banks. And again, we have also, a representative of the Big Four today in our panels. So it's also a key role validating the balance sheet, because we have just finished our annual audit, and I can really endorse that it was very cumbersome in a positive way, that our auditor has done his job properly, asking an endless flow of data, supporting documents in order to be able to sign off the statements and say, whatever the company states, it's in inventory, it's there, these are the receivables. So the question is how to create a robust control environment to be able to have one single source of truth in terms of the data collected and the data verified by a bank, by an auditor, and a trading company. Because the question is, speaking about balance sheets, as a credit manager, I can only trust the numbers that I see in a balance sheet and understand, what's the quality behind the company that I'm trying to review and analyze. Obviously, there are also other data that the credit manager needs to collect in order to finalize the analysis and valuation. But the question is, for instance, like we've recently seen in Singapore, how is it possible to cover up 800 million derivative loss? Because normally, in order to reconcile that, and again, in the course of an annual audit, you have to really look into the broker statement to reconcile really every ton, barrel, whatever applicable of product to any derivative position, and to see a perfect reconciliation thereof. So again, there are always roundup errors, could be some delta in that, but not to that extent. So the question nowadays is, how to structure risk mitigation, because the nature of risk has not changed over time. Fraud has been there ever since mankind is there. Obviously, it changes its appearance, its shape and form. The minute we have entered into the digitized universe, we are immediately exposed, to cybercrime, cyber fraud, or traditional fraud, like we have seen in Qingdao and in other cases. So the question is, what would be the instrument that would lead the innovation and the reshaping of the credit mitigation? Is it back to the old school tools, classical collateral management, so that the bank at the end will appoint a collateral manager who will survey the cargo on a 24/7 scheme and report the stock positions to the banks? Or are we going to take an even more innovative approach and accelerating the wave of digitalization that's already happening for a couple of years, and obviously now in a COVID environment even being accelerated? That's the question. when we will have an industry-wide standard that will address all this issue. And again, as every system in the universe, there has to be an industry-wide acceptance of any tool that's been provided.
Yeah, great. I would like to kind of echo what Alexander just said. And so in my personal opinion, when I was very young and started my career 20 years ago, I've been trained by a very old-fashioned school of bankers who basically, very much like Alexander said, had this saying, trust but verify. And I think that this is what we have to do. And I'm very much voting for a combination of old school checks with a combination of new technology. We have to kind of find a good mixture. Absolutely.
And again, you know, what is the future of collateral management? Everything about that, you know, I'm also in charge for my company, you know, for administration, and one big agenda there are internal control systems. So in the recent cases, there is a clear fact table that the control systems, if any, have certainly failed. And that's actually, we need, you know, to also testing internal control systems. So not just to formulate them and articulate them and say like, yes, they're there, but, you know, there need to be also frequent tests on it. Again, you know, to build a trust environment, but also a lot of control that will provide confidence, you know, to the marketplace, you know, from an insurance, from a banking, and obviously from a trading house perspective.
Jeff, I think that, so we pass the floor over to you again.
Thanks to you both. I suspect that's not the last we shall hear on this particular topic. We'll come back with some questions. I think we've got some questions for both of you and some of the earlier speakers too, as I mentioned, but please do keep submitting your questions. It's great to hear from our audience and to hopefully address any questions that you have for our speakers. This does bring us to the final section of today's webinar, which is our closing panel summary discussion, for which I'm delighted to introduce Sandra Pomero and Alex Dietz. Sandra is Global Head of Structured Commodity Trade Finance at Deutsche Bank, globally responsible for teams in Europe, Asia and the US, whilst Alex is Head of Global Trade and Receivables Finance for Switzerland at HSBC, having also held positions at Natixis and several trading companies, and welcome to you both. We've had these questions coming over the Q&A function. Before we get into some of those, there are some questions I myself would like to ask you both. Starting with you, Sandra, having heard from our previous speakers and reflecting on various industry discussions over the last few weeks and months, how do you see the financing landscape changing? Do you think we're looking at a more collaborative landscape with banks working more closely and a greater role for funds and non-bank providers?
Hello, Jeff. Yes, thank you, and very happy to take that question. First, also thank you for having me in that webinar, and I believe there is certainly room for further collaboration. Coming from a business where we are already financing companies in syndicated loans, it is of course so that we do already collaborate a lot with the banks that are in the same syndicate. So we are often a couple of lead bankers, we need to structure the deal. We have teams that do the syndication. It's separate from the sales teams for regulatory reasons, but there is already cooperation. With all I heard in the webinar so far, I believe it's also important to consider how do we make sure that when we have a secure transaction that the collateral we finance is actually there. So there might be, we have audits, etc., but there might be further room for collaboration really with the physical inspection, that not every bank visits the clients in a 2-week turn and in a syndicate with 10, 15 banks. So there might be room to grow that area as well. Of course, we also remain to be competitors, but I'm very sure there will be more need for structures, more need for tighter security concepts, and that also gives room for more collaboration.
Alex, your thoughts on that?
Yeah, I think the idea of club deals is not new. I think also what we've seen in, and I think it was really well phrased by Alex and Natalia in the previous session, is, you know, trust but verify. I mean, it has been our motto since we started that business. And I mean, I'm like Natalia, I started like 20 years ago, old-fashioned bankers with the BLs, and believe me, I was working for Elf Trading by then, and I was putting BLs in an envelope, and we were checking that the endorsement were correct and everything. So I think that's the key, and probably technology can solve part of this, but I think we are likely to come to that topic later. But what we've seen so far is that the landscape of financing will obviously change, and that there will be much more scrutiny over the transactions. What we've seen is that the winners around this in this market were the early adopters of technology, and they were the ones that had the end-to-end transparency over the supply chains, and that have also diversified also a lot the supply chain. I would say the financing requirements will for sure change, and because also what we've noticed is that the better capitalized company were the one that faced, I would say, much more easily the spikes in the market. And I think one thing that we briefly touched during this webinar was around volatility, but I think there was tremendous volatility during that period. I think nobody ever saw a barrel at -$40. Nobody ever saw probably some movements in the market resulting from $60, down in a single day. I mean, I've never seen that. I've been there in the oil business when we reached 138 a barrel, and I recall the margin calls, and I think that's the volatility also that creates a lot of risks, and this volatility needs to be understood, and probably the stress test and the value at risk going forward will be probably much more wider than they were before. So I think what will change tomorrow is that the way we look physical versus paper will be totally different.
That's probably moves on quite nicely. One of the earliest sections of this webinar was around the role of technology. How do you see the bank approach to digitisation and automation moving forward? Is it likely to continue or be paused as other financial imperatives take hold and potentially impact on bank investment in platforms?
I've heard some very good comments about from Sulema about technology and the fact I'm quoting her that industry was disconnected and you cannot make this happen in a bank. And I think it's an interesting comment because all of the banks have had their own, blockchain project. But at some point, we just realized that the main driver and the main driver to success was scalability. And scalability is by being collaborative and is by working together. And I think that Frank mentioned it also. We need solutions to real life. We need to move from this, I'm quoting him again, old-fashioned paper-based. And there was also a comment from Natalia with regards to LOIs. I think by definition, oil traders invented the LOI, long time ago. And probably that was the first move to, I would say, simplification or easing the process. And I think today with the technology that we have, and what is funny is that human is quite adaptable, and you see that when it's pushed to its limit, it can be very fast in deploying technology. Look at what everybody's on Zoom today. Nobody knew Zoom like 2 months ago. And I mean, I'm just surprised by the way Zoom has been implemented across the company. I'm in the office today because, we're somehow back in Switzerland, but Zoom is the new norm. Home office is the new norm. And, when you push people to their limits, the technology is following. So let's continue to push to the limits to make sure that technology is available.
But Alexandra, do you not also, I'm wondering, I fully agree with you in terms of efficiency that will increase with the new technologies. Also the standardization, that's absolutely positive and something I support. I'm just wondering whether we can really avoid fraud with the digital system. Natalia mentioned, and I agree with that, and you also have long-standing experience in the banking market, that we need to also have that physical contact to the client, and that we need to be there, that we need to have the discussions, and we discover signals for chances of new business or also risk signals, you will not see that in the balance sheet that has been published 9 months after the year ended. You will not see it even from quarterly reportings. You will get it from a face-to-face discussion with the client, and the digital system is for processing, very important, but I believe it cannot be a moving away from the on-site meetings, at least from calls, video conferences, but on-site after COVID again, hopefully. And sitting together with the client and really have a face-to-face discussion. It cannot go one, it needs to be just both.
Now, I tend to agree with you, but the reality is fraud in any case will remain fraud, and there will be always a way to fraud the system, because there are guys that engineer that all day long and that will think about another way. And if it's not through technology, they will do it through another way. And that's unavoidable. What we can do is reduce the risk of fraud, and that's clear. And I think that I don't know whether it was Natalia or Sulema who mentioned, and Frank mentioned Internet of Things, and no, I think Frank mentioned the shipping line example. And I think that's a very good example where we see today shipping lines developing their own blockchain solution, because on top of what we see as bankers, they have the control over the goods. They can freeze a container because they take the container from the warehouse and they transport it. And probably if they're not paid, I assume that they will keep the container until they're paid. And I think that's a good example on how we can embed within the technology, the different providers, being EBLs for sure. And I think there's a lot of industry and even governments that are now moving into EBLs. Internet of Things, Natalia was mentioning drones flying over inventories. I don't know whether it's efficient or whatever, but I think there's a lot of companies that have developed Internet of Things around, sensors in containers and this type of things that can be used by bankers. It's very simple and accessible technology for everybody. And I think through again, I come back to my scalability example, but the minute you have EBLs, that you have the shipping lines, that you start to have Internet of Things, I mean, the risk of fraud reduces a lot.
Just changing the subject slightly, before the current crisis, sustainability had become a major talking point in the market. Can the market move towards a more sustainable and inclusive ecosystem as part of what some see as a global reboot? Sandra, what are your views around that?
What we discover is that this certainly has become further dynamic over the last couple of months with COVID, because everybody really recognizes that it's important to think about changing the use of our non-renewable energy forms. So if we, for example, look at the use of oil, everybody was afraid that oil might not be, let's say, the source of energy going forward, when the oil price dropped so sharply that, and then everybody thought for a short while, okay, we might all move to sustainable fundings, to renewable energy forms. I must say this is certainly not possible with the population in the globe of 7.8 billion people, if I'm informed correctly. So we will need to still work with the traditional non-renewable commodity forms. But what we see a lot from clients is that they move more towards how do we drill, for example. Do we use wind energy to generate the energy for the platforms? Do we use solar energy for that? Do we move the whole industry towards a less polluting environment or industry? And that is a trend that we certainly see. On top of that, of course, also the trend towards more renewable financing forms, more wind, more solar, all the other industry forms that become more and more important. It will just take a while for them to really level off with the need for commodities, and then that they are there in a sufficient amount to really also give the people on the globe sufficient energy to do what they want to do. And we cannot, for example, say we skip digging for metals. Every cell phone has a lot of aluminium in it. So if we say we give up commodities, people would also need to skip the use of their mobile devices. which I think people usually don't want to do. So there is a trend. But Alexandra, I don't know how you see it.
No, I think I fully echo what you say, but I think sometimes we're just thinking about sustainability of just reducing the carbon footprint by cutting oil consumption and everything. But I think COVID gave us a lot of lessons around sustainability, because we just realized that, in fact, if you just shorten the supply chain, if you're doing more on the domestic side, or just probably European side for Swiss people like us or anything, and that I'm just saying that probably buying an avocado that has sold across the globe is probably not the right thing to do. But we saw also that by definition, and because of COVID, there were one or two countries that impose ban also on food imports, which means that, and some other imports, but that means that probably the protectionism is also somehow helping, I think, the sustainability and the supply chain. So we see that in the forthcoming future, the supply chain will be totally changed, and will be challenged geographically, I think, for sure, and that will have a massive impact on sustainability. And needless to say that, even from a commodities perspective and oil and energy consumption, I mean, I'm 2 days in the office a week now, and the rest of the time I don't burn fuel or electricity to come to the office, just because I'm staying home, and probably I lower my consumption.
I don't know how it is for you, but I feel when I'm out for a walk now and looking in the sky, it seems to be so much more blue, and this blue with the green of the trees, it's a nice contrast. So everybody feels also and sees also that it's worth rescuing and preserving our planet and thinking in new directions that will not go from today to tomorrow. But I think it's extremely important that we bear that in mind and that we support our clients on their transition to a more sustainable route.
That's a good message to finish on that point, I think. This next question concerns the issue of regulation, a thorny issue, as we know. Sandra, do you think we're likely to see a spate of new regulations come into force in the cause of business continuity planning, and in some cases some restructuring required for some companies, or is this likely to hinder things, do you think?
I think we are in an environment where we face three major challenges right now. So we started in the commodity industry with the oil price clash earlier this year, then COVID came, and we have in parallel and peaked recently a number of fraud cases. So in my view, the regulators try to help the governments around the globe to really preserve the economy from just defaulting, and they want companies to keep on performing. So what we have seen is that Basel IV has been postponed. The EU regulators have also encouraged the regulated entities to make use of flexibility. That's even in a formal statement on the EBA side. So we have seen flexibility on the measurement of forbearance measures when the problems of a company were really related to COVID. Will that be sustainable? I assume, and part of me also hopes that not, because we need to, of course, be regulated. Is it always the right level of too much and too little? I think everybody will need to assess that for themselves. I would assume that the regulators will also react to the higher level of frauds. Currently, it seems to me a bit that the COVID concerns are of higher importance across the globe, and the regulators seem also to see that it's not all driven by the banks now with those fraudulent experiences, that the banks rather suffer also from it, and that it's in the interest of the banks and of the clients and of the regulators united to prevent that from becoming the new normal. So we all want to reduce fraud, so we might see something more there. So far, I think there are more questions and there are considerations. I've seen a bit in APEC, but nothing too concrete. But it's also, COVID started, let's say, early this year. We are now in early June, usually before new regulation comes up. That also takes a bit.
Just to add on this, on my side, we saw an increasing roles and impact of the trade industries, and I know that Alex Peters, who just spoke earlier, is a member and director of the Swiss Commodity Club. I think we see in Switzerland, and Sulema is also a member, as Michiel, and I think we do as well, of the Swiss Trading and Shipping Association. And I think these associations are also very important to bring people together with one voice, and to also impose some good market practice and best practice across the industry. And I trust this association are doing a fantastic job to make sure that we overcome these problems, and again we have one voice.
Fantastic. Well, thank you both. I did mention that we'd bring back some of our previous speakers. We've got about 5 or 10 minutes left, and we've got a few more questions to get into. So looking at these, could I ask Natalia to come back? I've got a question here around insurance, which as our resident insurance expert, you'd be well placed to answer. Insurance has been said to be heavily exposed to the commodity sector during these recent difficult times. And Natalia, you've had plenty of experience in placing deals with the market. What are you seeing and hearing in the current climate when it comes to the insurance sector?
Thank you, Jeff. Obviously, that's a bit challenging times now, and if you didn't have any insurance brought to the market before, then probably it's a no-go right now, because obviously everybody will be concentrating on the partners that they've been dealing with together. And this is kind of a not kind of discrimination. It's just because to place a new deal in the insurance market is quite time and a lot of efforts exercise, including non-deal roadshows, promoting your brand, and then explaining how the market works. And if you talk about fossil fuel energy, it's basically very different. Oil is completely different from gas, and even gas markets, they are not homogeneous. So gas market in the US works completely different from the European gas market. So it depends on what deal you're bringing to the industry, and you need to kind of spend time with the guys for them to understand how you manage these risks, including this operational risk that we keep talking about now. Also, you need to kind of show the capability that if there are any negative outcomes, then how you would manage exposure. Will you be able to decrease the exposure quickly for you and underwriter not to be exposed to a massive loss? That's another skill that you need to demonstrate. I'm hearing from the traders that I'm speaking right now to that new deals is difficult, but at the same time, so there are plenty of examples when deals are placed in the market, and so the insurance companies support the trading companies well. Another big issue with insurance and fossil fuels industry generally, like you mentioned, so insurance very much exposed to the industry and with all green initiatives around the space. So we recently discovered that CO2 emissions are bad, but methane emissions, which is natural gas, is also really bad. And so they may be kind of in the long-term perspective, not that destructive, but they do affect massively the climate change in the short-term perspective. So currently people investigate the combination of methane and CO2 emissions, and credit guys also very much into this ESG initiatives. And this is something that we need to see, but my personal feeling that so people will be moving away a little bit from fossil fuels industries generally.
Got another question for you here, Natalia. It's something you touched on when you were giving your piece with Alex earlier. And it's a question with regards to the recent fraud and corruption cases involving commodity trading companies. Do you expect governments in markets like Singapore and Dubai to get stricter? And how would you see that on a practical level, bearing in mind those are markets that have built themselves up on very, shall we say, friendly regimes financially? And also when it comes to those companies themselves, how practical is it when many of them are often very small and family-owned businesses to be treated like FIs?
You know, I think that so friendly regime doesn't mean that so you can kind of give the chance to your client to get away with anything or what they want. So friendly regimes, I think that it means open dialogue, probably a bit more friendly tax regimes, but it doesn't mean that you need to hide information. I do believe that the markets will become a bit stricter, and I would like to echo Sandra's comment earlier that so you need to find a balance between too much and too little. If you introduce regulations, the problem is that traders are not regulated right now like any other institutions, but they do sometimes perform really complex financial transactions, spec trading. So basically, I think that the market should find a way to have a bit more controls over what people do. And as I mentioned before, I believe that the trick is to find a mixture between old-fashioned solutions and new technology.
Great. Well, I think we're almost out of time. I think we've got time for one more question. I'd actually like to bring back Frank and Salema for this question. It very much feeds into what they were covering before, if they're still on the line. So perhaps starting with you, Salema, and then hearing from Frank on this. You've heard a lot about the recent prevalence of cyber attacks in light of COVID. How are technology platforms in the commodity space, such as you guys, dealing with those potential threats? And bearing in mind all this talk around fraud, illicit dealings, do you feel that this situation will provide an opportunity for the market to come together to find a unified approach to tackling financial malpractice, should I say, across technology and otherwise?
Sure. So if I take the first part of your question regarding the platform, how do we protect ourselves? We have very strict security requirements. We have been audited inside out by all the users and biggest banks of the world who are using us. We have an external penetration test, which means that basically we are mandating eligible firms to hack us, right? To see if we are robust enough. So that's part of our everyday job. If I go back to the topic around fraud in the industry and what Sandra and Alexander were discussing before. So for sure, in our industry, you will never replace any human intelligence. That's not debatable, and no platform has this ambition and objective. This cannot happen. So I'm fully with you on this one. However, regarding fraud, I still think we can mitigate. We can use platforms to help us better mitigate it. And if we look at our history, I think that especially in financial institutions, they have massive investments on the compliance side following the fine, the OFAC fines 10 years ago. But I don't think it has been really the case on the operation side. And what you can use a platform for, and that's what we're using our blockchain for example, is to build a digital audit trail of what you do with the document. Because basically, for example, today you finance transactions on documents and you have no clue what other people have done with those documents unless you have the original one. And even if you have the original one, you need to double check it's the original one. So I think today the industry values almost as much as an original BL the fact of knowing who has done what with the document. And we have built this digital audit trail registered on the chain where the industry is where the different participants in a transaction can register if they have issued the invoice, certified the stock, paid the invoice, financed the invoice. And that's where we connect with the fact that this company is owned and created by the industry. It's because of that that we can bring additional value. This ecosystem brings additional value to this audit trail because everybody's using it at the end of the day. So yes, I truly believe those platforms can help us better operate and mitigate fraud risk. But I will never say that fraud risk can be totally avoided. We all know that very well too.
Yeah, and I think I would add to that without going into technical views, but what's the real problem with invoice, for instance? Invoice, we see that most of the invoice fraud is like changing the beneficiary bank account number during the transaction. So you get an invoice from somebody, the account number of the beneficiary has been changed. This, when you do it on DLT or blockchain technology, you can even detect whether somebody has changed a comma in an invoice during the process. So So you can be sure that this invoice you have received from party A, and this was the contents. And if something has been changed in the meantime, the system will warn you. So this is a little bit complementary to what Soleima was telling. You really trust where it's coming from, and also the technology to say, has it been changed during the process of passing it on to me or to my bank? So everybody can verify the hash of that document, and even the smallest change will change that hash and say this document cannot be trusted anymore. So I think technology can help us in reducing the risk of potential fraud. I believe this is where this is why a lot of people are crazy about the blockchain, because it brings you this extra layer of security that you are looking at the right document and the one version of the truth. I think this is important.
That seems a great place to finish. Thank you both. Thank you to everyone who submitted their questions as well. That brings today's webinar to a close. Thank you to all of our speakers for their time, and to you all for joining us. Sorry, unable to get around to addressing all of the questions submitted, though I'm sure our speakers will welcome any follow-up if you wish to get in touch. You'll be able to find their details, including the LinkedIn profiles, on the GTR website if needed. We'll be making this webinar available on demand via the GTR website later on, so please do expect an email with all details coming soon. Please also listen out for further announcements regarding GTR webinars, other exciting new activities, including our various virtual events planned for later this year, and hopefully with a fair wind, some physical ones also, as well as, of course, our unrivaled GTR coverage at www.gtreview.com. But until then, take care, and we'll see you all next time.